Free cash flow represents the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. It represents the cash available for the company to repay creditors or pay dividends and interest to investors. Free cash flow reconciles net income by adjusting for non-cash expenses, changes in working capital, and capital expenditures, or CapEx. Free cash flow is an important financial metric because it represents the actual amount of cash at a company's disposal. A company with consistently low or negative free cash flow might be forced into costly rounds of fundraising in an effort to remain solvent. Similarly, if a company has enough free cash flow to maintain its current operations, but not enough free cash flow to invest in growing its business, that company might eventually fall behind its competitors. For yield-oriented investors, free cash flow is also important for understanding the sustainability of a company's dividend payments, as well as the likelihood of a company raising their dividends in the future. Let's calculate free cash flow in our example for DCF modeling. We're going to take EBITDA minus a sum of change in working capital, taxes, and CapEx. I'm going to fill it to the right, and we just calculated free cash flow for our discounted cash flow analysis model.